Good morning. Today is the big decider.
Budget 2019 was proposed to be a roadmap for a new India, with the finance minister trying to pull off a balancing act. There were a lot of hopes, questions and speculations.
What is the context of this year's budget?
Being at the intersection of business, economy and politics, ET Now had a unique advantage to offer in-depth budget breakdown.
This is at best an incrementalist budget.
The sharpest takes from India Inc.'s top brass.
It's a very holistic budget.
Market veterans decode the budget trends.
I think this budget tries to really address the short-term challenges.
The biggest policy makers analyze the budget structure.
Focus of the budget is to spur growth again.
Getting the fine print of the budget math from its architect.
India still is the fastest growing economy globally.
And her sharpest critic.
Unfortunately, there's nothing in this budget.
The most accurate and unbiased budget coverage that you can count on. Only on ET Now.
Good evening, everyone. Before we kickstart the Money Show, here's a quick word of thanks to all our viewers out there to make ET Now their preferred destination for Budget Day, for helping with the budget analysis, decoding the budget math and getting you all the relevant and all the important voices from the market, from India Inc., all the governance, or whether it's the political leadership. Thank you so much once again for choosing ET Now as the #1 preferred channel for your business and corporate developments. All right, we have a whole host of things lined up for you on the Money Show today. Let's kickstart, of course. Before we do that, we want to tell you what all do we have lined up for you. First up, a very exciting discussion about gold, whether, what will be the impact of the hike in the import duties, whether it's the right time to dive in and perhaps purchase or park your monies into the precious metals. Should you add CPSE ETFs to your portfolio? That's another segment that we will be addressing today very shortly on the show. And lastly, a very interesting, a very consumer-centric segment in Spend with the Money Show. Spend with TMS, that's the last and final segment, where we will have a tech expert, a technology expert who will help you address all your queries with respect to gadgets and investing in technologies, and tell you about the emerging trends that are developing in that space. But for now, let's quickly see what the headlines are before we get on with the Money Show. ET Now is on top of Indigo tussle. Sources say SEBI is monitoring CEO Ronojoy Datta's clarification, playing down the spat between promoters. Meanwhile, Rakesh Gangwal is firm on his demands that there should be a cap on related party deals involving Indigo, and the dilution should be allowed only if more than 50% shareholders are on board. Crucial DHFL lenders meet today. ET Now learns that the core committee discussed ways to sell project loans and resolve retail and wholesale books separately. Sources say promoters haven't even been asked to pledge shares to raise their funds. Some green on the screens today on D Street. Sensex ends above 38,800. Nifty manages to close above 11,500, led by financials, IT and banking stocks. Hero MotoCorp, IndusInd Bank, Tata Motors and Vedanta led the charts, while Tech Mahindra, ICICI Bank and Axis Bank were the top losers. Temasek India's co-head speaks exclusively on investment plans, says it is looking to ramp up investments in India financial services, healthcare and agri-sector. Ravi Lamba also says tech startups are in vogue and he hopes to hike India portfolio allocation above 5%. The defense sector will consolidate and will not see more than 8 to 10 bigger players, says Baba Kalyani. Speaking exclusively to ET Now, MD of Bharat Forge says the slowdown in auto sectors is cyclical and NBFC crisis is stressing the financial system. In a move that will benefit Indian IT professionals, US lawmakers pass a bill to do away with the 7% country cap on issuing green cards. The new bill is expected to bring down the waiting period to get permanent residency in America. Disgruntled Karnataka MLAs camping in Mumbai leave for Bengaluru to meet Speaker after SC order, which has set a deadline of 6 p.m. Speaker has to decide on resignations by the end of the day. CBI raids homes and offices of senior lawyers Indra Jaisingh and her husband Anand Grover in the alleged case of violating a law of foreign funding. Kejriwal calls it political vendetta. TMC accused Modi government of harassing citizens and all the voices of opposition. Well, this is the Money Show with me, Karunya Rao. Let's bring on board our first guest who's joining us right here in the studios, Tarun Birani, founder and CEO of TBNG Capital Advisors. Tarun, hi, good evening and thank you for coming down. You know, there's been a lot of talk around gold, around investing the money in gold, especially for the last 1.5 years since equity markets have seen so much volatility. It has started picking up pace and even the prices have gone up significantly. It's once again back in focus after the government decided to hike the import duty as part of the budget which was announced last week. Just before we deep dive into how it impacts the costs, it impacts perhaps tax as well, let's understand how the prices have fared in the last 1 year or how the trend has been and whether or not it's a good time to look at gold.
Right. So I'm not a trend expert in gold and neither I believe in short-term trading. So, but just to give you a very clear-cut perspective around asset classes, I feel gold as an asset class is more of an asset which one should buy when there is a lot of fear in the street. Yeah. So, unlike other asset classes like equity and debt, which are return generating assets, like on equity you earn dividend, like on debt you earn interest, gold doesn't have anything like that. So, any asset which doesn't have a regular income kind of structure, I don't think it's an investment asset class. I strongly suggest all our clients not to have more than 10% into either of gold and silver as an asset class, because over a long period of time, gold as an asset class has not generated more than inflation kind of returns. So anybody looking at wealth creation from gold will be disappointed. Yeah.
Okay. You know, now let's talk about what exactly has changed for gold prices. Now, gold is likely to become dearer. The government has hiked the import duty to 12.5%. Custom duty on gold, silver, platinum bars, all of them have been raised by 2.5%. Imported 10 gram Swiss gold coin to cost higher by 900 odd rupees. The move is likely, in fact, implemented to tackle perhaps the unofficial import of gold. Now, give us a sense of, you know, this hike that has happened in the gold as well as silver, and what is the tax impact of this hike?
So clear cut, from a 10% custom duty, we have moved up to 12.5%. Right. Apart from that, there is a 3% GST. So total impact on a buying of gold is 15.5%. So which has led to the increase of the gold prices, gold and silver prices in the country. So clearly the tax impact is the prices of gold and silver has become more dearer. Apart from that, there is a lot of dovishness across the globe. You see US, European markets, the interest rates are coming to all-time low because of the lower economic activity due to trade wars, fear. Apart from that, geopolitical risk. Due to that, we are seeing a lot of interest earning assets are going lower and lower. At that point of time, gold is becoming an attractive asset class. That's why we are seeing the gold prices globally are also going up. And with the tax increase in India, I think we are seeing it going much higher in India.
What's the kind of demand change that you are expecting or you're anticipating on back of this change, on back of the hike in gold import?
So demand change.
And especially, I'm sorry to interrupt you, especially for physical gold.
Physical gold. So I can see from last 5 years, this establishment or government is very clear cut that they want more and more assets to be financialization of asset is what we are seeing as a trend. So we have seen sovereign gold bond has been introduced, gold ETF has been promoted. All these have been done to ensure that more and more investors start coming into financial assets, not into physical gold buying. Because first of all, it is having a very negative impact on the current account deficit of this country, because as we import more and we are anyway a deficit country, so it leads to the currency changes happening much more abruptly. So due to that, government want more and more financialization of gold, and that's a one clear-cut trend which I am seeing. As I speak to most of the investors, more and more inquiries are coming for gold ETF as well as sovereign gold for bond funds.
Okay. You know, many of us out there, a lot of our viewers and even consumers from their standpoint, if you could talk to us about what are the different avenues to invest in gold. Of course, physical gold is something most people on the street are aware of. But other than that, what are the better ways or more convenient ways to park their money in gold?
So there are 4 ways through which an investor can invest in gold, either buying through traditional gold bars or gold coins available. Second option available is through ETF. Gold ETFs are available, sovereign gold bond funds are available, and fourth is digital gold, which is very much prevalent today. So all these new platforms like Paytms of the world, they are coming up with all these digital gold. So roughly these 4 options are available. From a taxation point of view, the gold bars as well as the gold ETF as well as the digital gold have a short-term capital gain. Before 3 years is roughly the money gets added, any income generated or any gains generated is added in your income. More than 3 years, you get the indexation benefit, so you end up paying 20% tax and you take the inflation benefit. But the sovereign gold fund, and I think that is one of the biggest change in last 2 years after it has been launched. The gains which you generate is completely exempted. So for investor from a taxation point of view, it's very efficient. Yeah.
Thanks for highlighting that for our viewers as well, Tarun. Just, let's get on board now with some of the viewer queries. A couple of people who watch our show regularly have reached out and they have very goal-specific questions. First up, there's an email that we have from Mr. Vivek Sharma of Delhi. He's saying that, globally experts are giving an advice of about, $2,000 target for gold. Is it a good time to start investing in the precious metals, given the kind of high targets that everybody has been giving online and across reports, etc.?
So Vivek, I have clearly made that disclaimer in the start. I am not a trader, neither. I can predict the prices. I am not an astrologer, but looking at the current macroeconomic as well as global trends, I can see that the gold and silver prices tactically are looking at an upswing kind of stage only. But my suggestion would be, rather than looking at it from a 2,000, 3,000 or a kind of structure, I think you should rather look at it from your goal perspective, whether you have that kind of time horizon available to invest or not. Because we have seen cases from like last 5 years, gold has given absolute flat or negative returns. So are you ready for such structures? And we have seen in 1980 to 2000, gold has given negative returns for almost 20 years. So it's very difficult to predict because these macroeconomic changes happens very fast. So my suggestion would be, rather than playing tactically, play it with your goals and needs. And if you have a long-term goals and needs, ensure 10% of your money is available into gold.
Okay, that makes sense. Let's move on then to our next query as well. Ajay Mehta of Surat has written to us. He has a corpus of 1 lakh and the time horizon is 2 to 3 years that he has given. Wants to understand which is a better bet, silver or gold? 1 lakh rupees, 2 to 3 years. What would be your advice?
So again, very, very tricky question, but I would say that among silver and gold, silver has much more industrial use. So that's why the demand for silver will be much higher, and we see the prices change will be much higher in silver compared to gold. And so trust me, I cannot give you a return expectation from either of silver and gold, but my sense would be ensure that it doesn't breaches 10% of your overall portfolio.
Okay. Okay, that's a prudent advice. Moving on then to our next query, Prakash Tyagi from Kanpur has written to us. Wants to know what is the better alternative investment for gold over the next 1 to 2 years, given how you, Tarun, had told us that the returns have not been very good and it is a slightly risky proposition. So if not gold, then what can one look at?
Yeah, so looking at the horizon, time horizon, what he has mentioned for next 1 to 2 year kind of horizon, clearly I think debt is the only asset class one can look at, because the time horizon which he mentioned is very low. But my suggestion would be, if he has a time horizon closer to between 2 to 3 years, he can look at asset classes which is a mix of debt and equity. So if you are really genuinely interested in wealth creation, you need to have some equity bit for growth or for long-term growth. So you can look at some hybrid structures like dynamic asset allocation funds, which we have seen over a period of 3 years have generated more returns than debt funds. So one can look at those structured dynamic asset allocation funds.
Okay. Well, that's something you can look at, perhaps, given that you have a time horizon of a very specific 1 to 2 years. Prakash, thank you for writing to us. Let's get on board our last and final query with respect to gold for today. Karishma Khanna has written to us from Lucknow. She is asking that for a middle income person, is it better to invest in gold jewelry or gold coins? Also wants to know your view on gold bonds and ETFs as well. So it's a all-encompassing question.
Sure.
What would be your advice?
So Karishma, from an academic point of view, I'll answer all your question. But if you ask me very clearly from a long-term wealth creation point of view, you need to look at, come out of gold if you really want to generate wealth. Coming to your specific question, as I earlier also mentioned, there are 4 ways to look at investing in gold. So I would suggest you should better look at a gold sovereign bond funds compared to all these gold coins as well as gold physical gold, because here you end up generating 2.5% returns. The taxation is low, so it makes a lot of sense to buy gold bonds. That's my suggestion.
All right. Well, that is the suggestion then. Thank you so much, Karishma, for touching base and writing to us about your query as well. Before we let you go, Tarun, just one last question I'd like you to address for all of our viewers out there. It's not a query as such, but our last query was talking about a whole host of avenues. At this point of time, for somebody who is just starting to invest their money in gold and is also, perhaps looking at not a very high amount at the same time.
Sure.
Just small, gradual investments, somebody who is looking at it. From that point of view, what would be your, advice to them? What is the approach they should have when they're looking at any precious metal? And what is the vehicle they can use in order to invest in one?
Right. So, first of all, my big suggestion would be, first of all, be very clear about what is the purpose and goal behind investing. One need to be, as an investor, you need to be very clear about your purpose. Once the clarity on the purpose part is there, the next part becomes very, very clear. So, once the goal is decided, you know that it's a 10-year horizon, then it opens up a lot of things for you. But if you know the money is just available for 2 to 3 years, then you would look at structures very, very differently. So my suggestion, gold should not be more than 10% of your asset class. It should be defined more towards your, let's say, a social need, or let's say for your kids' marriage goals and all those things. Gold should not be more than that. Apart from that, if you look at structure, I would recommend a sovereign gold bond funds, but they are not available currently. So the next best option would be gold ETFs that can be looked at.
Okay. Yeah. Okay. Great for giving us your perspective and for addressing all of our viewers' query as well, Tarun. Thank you so much for joining in. On that note, we're going to slip into a short break. We have plenty more lined up on the other side. Come back soon. back. You're still watching The Money Show on ET Now, and we have an investment mantra lined up for you in our segment today. Morgan Housel spoke exclusively to ET Now on what will be the next big idea and why should one focus on long-term investing when whole composition of growth and companies in disruption are back.
Well, I think if you look at the long history of markets, we're always going through these periods of extended volatility. The periods of relative calm that we go through are what stands out over history as being odd and abnormal. The periods of volatility tend to be the more normal periods. Obviously, anytime you have a big national election, as I know just occurred in India, you have periods where you have investors just trying to size up what's going to happen to the economy in the near term, what new policies are going to be put in place, just a lot of uncertainty going in and out. And so that can have an effect in terms of increasing volatility. But I think in terms of, we had that in the United States as well at the end of 2018. We had a very large period of volatility and our market fell about 20% in a period of 2 or 3 months. But if you look historically, that kind of volatility, a 20% decline in the market is something that would happen 3 or 4 times per decade. So it's not something that's that rare. And if you're a long-term investor, it's what you should expect to experience on a fairly regular basis.
Morgan, you've always been a big practitioner of fear and greed, which is that good news and good prices, they rarely come together. Right now, we are in an environment where the globally news is not great. The fear of trade war, fear of what will happen to Japan, how exactly the US economy will move because the sugar rush soon will get over. But even though the headlines are not great, markets are at an all-time high. Historically, when the headlines are bad, stock prices, they always correct. Everybody is waiting for a correction, the environment is slightly noisy, yet asset prices are getting inflated. Why is there such a dichotomy?
One thing that I think is interesting right now is the extent to which we've had a 10-year bull market and markets have done really well and a lot of people have made a lot of money. But at the same time, so many investors around the world are still scarred from the 2008 financial crisis and how much money they lost during that period. And it's this weird dichotomy of trying to find the balance between those two emotions. I've made a lot of money in the last 10 years is what most investors would say, but I'm still scared of what happened in 2008. I'm scared of that happening again. And I think the balance of those two emotions, I think probably still leans towards fear of 2008. I still think the fear of 2008 is one of the prevailing sentiment drivers of global markets these days. Even though valuations are high, even though interest rates are low, even though markets have done so well, I still think investors are much more on edge than they would have been, say, in 2007 or in 1999 or 2000. I don't think where we are today compares to those. That's not to say that people should temper their expectations of future returns or that they shouldn't, be prepared for, what might look like greed today, turning the other way and turning into a fearful environment. Of course, that's always a chance. But I think 2008 still prevails, and I also think it will prevail for a lot of investors the rest of their lives. It's something similar to the Great Depression, where it was so powerful and so traumatic that it's something that sticks with people for the rest of their investing careers.
Morgan, the investment world is famous for writing newsletter. The annual letter from Warren Buffett, the memos of Howard Marks, the newsletter which comes from legendary investors like Ray Dalio. They really pour in their understanding of the world and how they have learned over the years by simply observing and participating market cycles. So if you have to write a letter to your boy who's 3 years old, how will that letter start and how will that letter end?
Well, I have a son who's just over 3 years old. When he was born, I did write him a letter about my financial advice that I would give him. And it began by looking at investing not through investing recommendations or anything like that, but just thinking about what good money is and what money does for you and what money does not do for you. And thinking about
All right, let's welcome on board Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth Management. Feroz, thank you so much for coming on board. What we essentially wanted to address is the whole idea and the concept of investing in ETFs, especially the CPSE ETFs. Now, of course, in the budget last week, we've seen government's thrust on divestment in a big way of public sector enterprises. So, given the fact that a new tranche is also likely to be launched, likely to be started next week onwards, just want to understand ahead of that, what are the new avenues that the budget has now opened up for investments and to save tax by putting a thrust in a big way on avenues like CPSE ETFs? Is it worth taking a look?
Definitely, it deserves a look for sure. From a perspective that an EPF, CPSE ETF is something which is going to be a combination of PSUs, like you rightly pointed out. It is basically to bring down the actual shareholding of the government in the PSUs. So point one, it is a good idea. Point two, there is generally in a CPSE ETF when it is launched, and if you're not buying it from the secondary market but in the primary market, you get a discount to the price on the market, and historically it has been 5 to 7% as well. So that gives you a little kicker and a motivation to participate in a well-rounded basket of PSUs with some discount. The third thing is the constituents of this ETF have a larger dividend yield, as much as twice more than the other Nifty stocks. So I would say it's a high dividend yield paying an ETF. So price rises could be lower, but they have a recurring kind of a payout. So that's the third thing. Now there is talk of including them under Section 80C. So you have 3-4 levels of motivation being given. So it becomes more and more attractive to make sure that there's a win-win. Government's disinvestment happens because the response in the previous series has been quite overwhelming, and disinvestment without impacting market prices has been achieved using this vehicle. So I would definitely say it deserves a look, and in fact for a retail client, definitely a very good vehicle, because ATC becomes a very important element of somebody being in the retail side trying to save that tax, because its PPF and EPF don't contribute 1.5 lakh. For HNIs, it's already used up in some form or the other in involuntary contributions towards ATC. In retail clients, there is a headroom that definitely CPSE can fill in.
Okay. What's the kind of saving, or what's the kind of relief are we looking at when it comes to tax savings once we invest, if and when we invest in a CPSE ETF? If you could cite an example of somebody who falls under the 5 lakh slab and beyond as well.
See, if you look at the 5 lakh slab, then it is not so attractive because you've not reached that limit of extensive tax deduction. It becomes more and more valuable if you have crossed the 10 lakh slab, because you are in effect, if you don't use the ATC deduction, you will have a 30% taxation. So point one I'm making is, if you are in the 10 lakh bracket and you've only utilized 1 lakh as your limit already in the form of some insurance contributions, some EPF contributions, and if you still have 50,000 left, you can use this on the CPSE ETF and get a tax deduction or a tax saving of 30% of that, which translates to 15,000 rupees, is what is the initial kicker you can get by filling in the gap using a CPSE as against a ELSS. Of course, the ELSS will also give the same benefit. So to answer your pointed question, for somebody in the bracket of the highest tax slab, this could save 30% of the investment plus the cess, which could be 33% in effect of the contribution you make. If it's 50,000, 30%, 33%, 1/3 of that, close to 16,000 rupees is what becomes the total tax saving on this vehicle if used. Apart from this, you of course have the 50,000 rupees on NPS, which also is something at this point in time it's worth highlighting to the viewer, because the usage of the separate 50,000 limit using an NPS hasn't been evaluated and exploited as yet by a large number of taxpayers.
You know, I'm sure by now you must be very, very familiar with the fine print of the budget that was unveiled last week. Is there a way for the common man to sort of make their portfolio budget proof? I mean, yeah, it might sound a bit absurd, a little funny as well. But, the whole host of things that were announced, some did impact the Aam Aadmi and some did not so much. But overall, if somebody wants to sort of make it completely foolproof as far as the budget impact is concerned, what is the kind of strategy one should adopt?
See, fortunately, budget is always a celebratory moment for anybody on the retail side, if not directly, indirectly. It is always going to be, or gradually as we progress into being one of the largest economies in the world, it's going to be bad news for the rich and the super rich. So point one is, if I was a retail person, a retail client, I wouldn't be too worried about protecting myself against the budget. Now, if you look at the fine print and this specific budget, was there anything announced for this group of the lower end of the pyramid? I don't think so, but I don't expect that to happen as well, because there was just a budget 4-5 months back and that did a great job. So today you have 14 lakh rupees can be earned by a specific person. In an Indian context, it's a large number if you look at the per capita income of our population. Till 14 lakhs, you can use up all the deductions and pay zero tax. That's a very, very large non-taxable limit if you utilize all the provisions. So point one, budget proof, I think budget has always been pro the lower pyramid. Point two, I am again highlighting that you can go scot-free with zero taxation up to 14 lakhs if you actually use up all the provisions under different heads available. Point three, the other perspective which a person needs to understand is not just tax. It's also on his savings, the impact, which is investment perspective. If you look at the investment perspective, you look at how the economy will get propelled as the budget size inflates for the country. I think equities will do very well, which will indirectly create growth in the savings of these retail participants, which are now coming lock, stock, barrel in the mutual fund industry in the form of systematic investment plans. So there's an indirect push to the savings growth because the budget didn't actually mention too much on the real estate side. So flight of capital from real estate, equity to real estate doesn't seem to be on the cards. So equities will still continue to do well over long periods of time. And that's where the retirement corpus is, which I think is the biggest challenge for the Indian Aam Aadmi, gets addressed.
Right. Okay, Feroze. Thanks for getting, pumping in some enthusiasm for our viewers as well about the budget, because ever since the budget has come out, there's been a lot of concerns as well with respect to a lot of announcements that came out. One of them being the surcharge applied on the super rich. Now, of course, we saw how the FPI sentiment was hurt big time, and we've seen a massive sell-off in the early part of the week. But help us understand, how are you assessing this whole situation and this development? What is your view?
See, of course, there is some degree of bias because my clients, and there is some degree of implication and vested kind of implication to this, because if you are a part of the super rich, then you get taxed extensively. So point one there, I think I am not very pleased with the way it has been charged, by which I mean charging the rich is definitely something which should be done in an economy. That should have been done in a more transparent fashion by increasing the slab from 30 to 37% if you so wanted to do it, rather than increase surcharge. So one point I'm making is surcharge has changed, which means that surcharge is applicable not just on your salary, it has implication on LTCG, it has implication on STCG, like you rightly pointed out. This tax, which is also going to impact FPIs, will have some kind of an effect. So if they actually increase the slab from 30 to 37 for that group, would have been a better strategy. Point two, if you don't do that, then you're taxing the super rich twice, because if you pay a higher tax and get a smaller savings, after you've already got a smaller savings because of a higher rate of 42.74, after it has been paid for, again taxing the savings at a higher rate differential is not something which is a practice globally. So that's one thing which is displeasuring. Third point is, by doing this, if you do the back of the envelope calculation, the tax revenues would just go up by 12,000-13,000 crores. but the economic impact or the psychological impact of the spending patterns of these 6,300 and the 50,000 odd people in the 2 to 5 crore category will have a larger economic impact because you've suddenly cut down the market for German cars because the disposable income comes down, the propensity to spend comes down. So I think that economic impact could be larger than the direct tax revenue which the government can collect. So so it's not gone down well. And the last important point is that there are workarounds. So if you make such large changes, then the HNI has different mechanisms to legitimately make sure that he is in different brackets. People are now speaking of, I have interacted with several of these in the 6,300 people, and they're contemplating of making private limited companies, LLPs, trusts, to make sure that their incomes are not taxing them significantly more. So people will bifurcate their salaries and investment files to bring down taxation, which is not a good practice and disincentivizing effort, because a person who's earning more than 5 crores is putting in effort. So disincentivizing them is not a good idea from an economic standpoint. But I completely subscribe to the view that they need to pay more tax, but not in this fashion. It is a more opaque fashion. There could have been a cleaner method.
Right. All right. Thanks for sharing your views on a whole host of issues and a whole host of trends that are emerging. But let's also address our viewer queries as well. We have first up a mail from Ramani. They say that they're 24 years of age and looking for a tax-saving investment option and wondering if investing in ULIPs is a good idea. Was looking at investing about 10,000 per month, and the time horizon is 10 years with an incremental investment of 10%. They also intend to stay invested for 15 to 20 years, and they want to know which ULIP plans are worth investing into. Feroze, I'll leave the floor to you. What would be your advice?
See, I think I'm against ULIPs dramatically, and I think I would make my stance more vocal, saying that I would definitely not buy a ULIP, and I have personally not recommended or bought a ULIP for the last 10-11 years because data says so. So you should not buy an ULIP. If tax saving is your purpose, then ULIP is not the best of the vehicles, in my opinion. And we analyzed 2,000 different ULIPs held by 2,000 different people. After 10 years of having held them, the average return was 5.7%. This is across cutting through different service providers, different time zones. So that's when we realized that the returns being as little sub 6 is definitely not worth an investment, because there are different charges which bring down the ultimate output. So ULIP is not a good idea. If your tax saving is important, then use an equity linked savings scheme. Buy yourself a term plan to complement that, to make sure that you get your insurance from one side, you get your investments right from the one side. Don't try and combine two objectives. You will not be able to achieve them optimally together. So bifurcating them is the best idea, and it can actually leave you with twice the quantum at maturity. That's the kind of impact of these two different strategies. The straight ULIP or the bifurcated strategies can leave you with twice more maturity corpus, and that's what data says, not just me. I'm just representing the data.
Right. Okay. Feroze, let's move on to our next query as well. Mr. Subramaniam Nataraj has written to us. He's invested in 3 mutual funds in the last 5 years. Let me quickly read out his portfolio as well. Firstly, there's SBI Equity Hybrid Fund. The corpus accumulated there is 17 lakhs. HDFC Equity Hybrid Fund, the corpus there is 7 lakh, and IDFC Multi-Cap, where he has accumulated 3 lakh rupees. He's currently stopped SIPs, but he continues to stay invested in these funds though. His goals have also been very, very clearly highlighted. For children's education, the amount he's set apart is 30 lakh rupees. Time horizon is 5 to 6 years. For the child's wedding, it's 75 lakh rupees from a time horizon of about 10 years. Wants to invest the above corpus, which I just stated is 30 lakhs and 75 lakhs, in any other funds to achieve the targets. The corpus that he has accumulated, actually 17 lakhs, 7 lakh and 3 lakh, almost 27 lakh rupees. Please suggest funds and amounts to be reinvested. He's given a lot of details. His goals are also very, very clearly defined. Feroze, what is your view?
I think Mr. Natarajan has done a great job in terms of being clear of where he wants to get to. So if you know where you want to get to, the odds of getting there itself go up. So that's very heartening to see. Point two is that what will it take to get there is that he will have to have an SIP of 16,000 rupees on the next 10-year basis, on a monthly basis for the next 10 years to be able to have a reasonable probability of achieving his goal and not falling short when the time arrives for the utility of money. Point three is that, again, I would like to reiterate that most of the decisions in your investment world have to be driven by what data has to tell you, because India has been has had a capital market and a mutual fund industry long enough for you to derive inferences from where it is. So let me tell you that a hybrid fund, which is nothing but a balanced fund like the erstwhile regime as they were called, are not a good idea. Especially after the tax changes of April 2018, 1st April 2018, it becomes even of a worse of a investment. So always try and separate them, having the debt fund separate, having the equity fund separate. If you combined your asset allocation, because he has 28 lakhs, he's not a retail client with 2,000 rupees. If a 2,000 rupee SIP needs to go into one fund rather than two separate funds, you can buy a balanced fund and get the mix of both. You cannot have a balanced fund at 27 lakhs because we analyzed the top 10 asset management companies and their balanced funds. If it was segregated, they would get 2%, clients would get 2 to 2.5% more return in the same asset management company using separately rather than a combined portfolio. So as per data, you should not buy balanced funds. So two of his funds get into an exit category, and then he has an IDFC multi-cap fund. I would not buy equity from any asset management company which is not in the top 5 list at least. So IDFC would be an exit as well. So all three funds should be exited. Ideally, if they were mine, I would have sold them, and I would have bought Reliance large cap, Mirae Asset large cap, and Canara Robeco emerging equities. So these three funds will be complementary in nature, and you can replace the multi-cap fund with Kotak Standard Multi-Cap managed by Harsh Upadhyay. So these 4 funds and a 16,000 SIP into the same 4 funds could be a good start point to embark on the journey of meeting your goals.
Okay, there you have it, the whole host of things that you can perhaps do with the corpus that you have accumulated. Thank you so much for writing to us, and Feroz, really appreciate you taking time out, coming down to our studios and talking to us about a whole host of trends and helping our viewers out as well. With that, let's slip into a short break. We have another very exciting segment lined up for you on the other side. Stay tuned. Welcome back. You're still watching the Money Show right here on ET Now, and we have a very exciting segment lined up for you, the Spend with Your TMS segment. We have Nikhil Chawla, founder of the Unbiased blog, joining us right here on the show. Hi Nikhil, thank you so much for coming on board, and we have a lot of questions for you, a lot of consumer-centric questions. So we'll first address a couple of viewer queries, and then we'll perhaps discuss some emerging trends in the technology, gadgets and appliances space as well. Okay, so let me quickly pull up the first query. It's from Ashutosh Gupta of Lucknow. His budget, he says, is 30,000 and he wants to buy a laptop. The key requirements that he has is a Core i3 processor, pre-installed Windows and MS Office. So very basic needs. Perhaps the utility that he's looking for is also very, very basic. What would be your advice? What are the brands that he can look at, or what are the models rather he can look at? Because for brands, he's very specific between HP and Dell.
Okay, sure. So first of all, the requirements he has, he can get Windows pre-installed on these devices that I'm going to refer. But for Microsoft Office, he has to buy a subscription, because now Microsoft Office comes in a subscription-based plan where you pay monthly or annually. So at this budget, you won't get a laptop that has MS Office pre-installed on the device. And the models that I specifically would recommend from HP is HP 15 or HP 14Q. And again, these are with Windows, but you have to buy Office again. And from Dell, I would recommend him the Dell Vostro and the Dell Inspiron, the basic series, and it would be Inspiron 6585 and the Vostro 3565. He can look at those laptops, but my personal recommendation to him would be the Lenovo IdeaPad 330, because it has a better design and the display goes all up to the way 360 degree, and that gives you 2 form factors in a laptop, which is a much more usage than a regular laptop.
Okay, all right. Well, I hope our viewers taking note of all the models that you did specify. Thank you so much, Vivek. Ashutosh for writing to us with your query as well. Nikhil, let's move on to the next query as well. This is also quite specific. Meghna Singh from Amritsar has emailed us. She's asking which is the best options between Redmi, Oppo and Honor. These are the three brands she's looking at. The price that she wants to buy, the budget that she has is 16 to 18,000 range. She says the phone should have a good quality camera, sound quality should also be good, and most important is the battery life. So Nikhil, over to you. What would you recommend?
Hi Meghna, I would say it's just the right time to ask this question because both Oppo and Redmi are launching two new phones next week. So either you can wait for those two devices to come because they'll be again very good for the mid-range segment, the segment you're looking for a device. But if you can't wait, then I would suggest the Oppo K1 and the Redmi Note 7. Both these devices have great cameras and latest features, good sound quality, and battery backup is amazing. And I think the device that you're looking at should be something between the Redmi Note 7 or the Oppo K1 depending on the features you need. Oppo K1 offers you an in-display glass fingerprint sensor, which is like a really innovative and nice feature to have. On the other hand, Redmi Note offers you a great battery life, but I would not suggest Honor phones for now because the reason I would say that is still the US sanctions, we are not very clear with the Honor devices would be getting future Android updates or upgrades. So in my recommendation as an expert, I would not ask you to pay 18,000 rupees and then never get Android updates for. So Honor devices a complete no-no for right now. But in the future, if things progress, I could really recommend them. For now, I think you would be able to choose between a Redmi or an Oppo device depending on what you like most in both of these devices.
So big no-no for Honor, at least for now. Oppo and Redmi, something you can explore, Meghna. Thank you for writing to us. Moving on to our next query, Shikhar Agarwal of Delhi has gotten in touch with us. He wants to know which is the best smart TV to buy under 30,000. Nikhil, firstly, I'm a little surprised that there are, smart TVs available in that price range. But what would be the kind of brands that one could look at?
Yeah, that's really surprising for everybody because the technology has evolved so much and the commoditization of technology has given us TVs that start low as 10,000 rupees for a smart TV. Obviously, the screen size would be too small, but you can get smart TV starting at 10,000 rupees. So right now, the question is for 30,000 rupees. I would recommend two companies that I've been using personally. That is, one is Thomson, another is View TVs. Both are like made in India TVs and really good TVs, and I would recommend them because I've been using them personally. In 30,000 you get around 55 inches of a smart TV, which is a great deal. 50 to 55 inches of a huge smart TV in both of these companies. You can also look at Mi TVs, which are great. They offer great software, great optimization, but again, I haven't used them personally, so I can't recommend them, but I've really heard good things about them. So I would say you can obviously go to a Mi store and check them, and also you can check the View TVs at your local stores. And the decision should be between a Mi or a View TV or a Thomson. That's what I've personally seen and recommend.
Okay, Nikhil, we're a little pressed on time, so unfortunately that's all the queries we'll be able to take on the show, but really appreciate you taking time out and chatting with us and also helping our viewers out with their whole host of very, very specific consumer queries about investing in appliances and buying and investing their money in technology. Thank you so much, and on that note, we're going to wrap it up on this edition of The Money Show. Thank you so much for watching, and thank you once again for choosing ET Now as your preferred destination during the budget day and making it the #1 channel, the #1 Indian business channel. 55% has been the channel share on 5th of July. That's the budget day. Thank you so much, viewers, for trusting us with all your updates and news.